Good day, everyone. We are the Group 6 and we are here to present to you Chapter 12 and Chapter 13. For our presentation outline, here are the topics that we are going to discuss. First, Chapter 12 that talks about the events after the reporting period, and Chapter 13 which tackles about the related party disclosures. To start off, let me introduce myself first. I am Jamaica and I am going to discuss Part 1 of Chapter 12, the events after the reporting period under the Philippine Accounting Standard 10. Before we formally start, let me present to you first the technical knowledge for this chapter. So first, to understand the concept of events after the reporting period. Next, to know the types of events after the reporting period, and lastly, to understand the recognition of adjusting and non-adjusting events. Now, what exactly are the events after the reporting period? To begin with, according to Philippine Accounting Standard 10, Paragraph 3, defines events after the reporting period as those events, whether favorable or unfavorable, that occur between the end of reporting period and the date on which the financial statements are authorized for issue. Events may occur between the end of the reporting period and the date when financial statements are authorized for issue, which may present information that should be considered in the preparation of financial statements. So, events after the reporting period provides guidance as to which events should lead to adjustments in the financial statements and which events shall be disclosed in the notes to financial statements. Events after the reporting period are also known as subsequent events. Such events may require either adjustment or disclosure. Events after the reporting period may be classified in two types. These are the adjusting events and the non-adjusting events. The first one is the adjusting events. And as the title says, you will make some entries as a result of those events. So, what exactly is an adjusting events? Adjusting events after the reporting period are those that provide evidence of conditions that exist at the end of reporting period. In other words, these events might have happened after the end of the reporting period, but they were a result or a consequence of something already in existence. So, the thing you need to do is to adjust the amounts recognized in the financial statements. In adjusting events, according to the definition provided, there must be evidence of conditions that existed at the reporting date. Here, you will only adjust the recognized amounts in the annual financial statement. So there will be a change in the statement of financial position or change in the statement of profit and loss. The second type of the events after the reporting period is known as the non-adjusting events. So non-adjusting events are those that are indicative of conditions that arise after the end of reporting period. In this case, you do not adjust the financial statements. There are no recognition adjustments. The thing that you will only do is disclose the notes. You will not change the statement of financial position, but you will do a note and disclose the following, which are the nature of the events and the financial effect, or the statement that financial effect cannot be determined. The entity is required only to disclose significant non-adjusting events. Now we're going to proceed to the examples of adjusting events and non-adjusting events to be discussed by Ms. Oliveros.
We have here examples of adjusting events concerning the different business transactions which are literally accountable or recognizable that gives adjustments in effect on the asset, liability, and equity of an entity. First example, the settlement after the reporting period of a court case because it confirms that the entity already had a present obligation at the end of reporting period. Second, bankruptcy of a customer which occurs after the reporting period. The declaration of bankruptcy by a long outstanding receivable after the reporting date may provide evidence that the receivable was impaired at the reporting date. Impairment may be recognized in the financial statement by reducing the amount of receivable to its recoverable amount, if any. Next, sale of inventories after the reporting period may give evidence about the net realizable value at reporting date. Fourth, the determination after the reporting period of the case asset purchase or the proceeds from assets sold before the end of reporting period. Next, the determination after the reporting period of the profit sharing or bonus payment if the entity has the present obligation at the end of reporting period to make payment. Next, the discovery of fraud or errors that show the financial statements were incorrect. The detection of fraud or errors after the reporting period may indicate that the financial statements are misstated. Financial statement may be adjusted to reflect accounting for those errors or frauds that relate to the present or prior reporting periods in accordance with IAS 8 accounting policies, changes in accounting estimates, and errors. Notice that all of the examples that you have heard and read were stated that it was after the reporting period, giving us the knowledge and information that we cannot have the adjustments at the very beginning of a particular transaction or before the reporting period. Let's proceed to non-adjusting events which also applied after the reporting period concerning the same thing. First example, business combination after the reporting period. Second, plan to discontinue an operation. Third, major purchase and disposal of asset or expropriation of major asset by government. Fourth, destruction of a major production plant by a fire after the reporting period. The destruction of assets of the entity by floods, fire, and other casualties occurring after the reporting period does not indicate that the assets of the entity were impaired at the end of reporting period. Hence, the financial statements should not be adjusted to account for the impairments loss that arose after the end of reporting period. Next example, announcing or commencing the implementation of a major restructuring. Next, abnormally large changes after the reporting period in asset prices or foreign exchange rate. 8. Entering into significant commitments or contingent liabilities, for example by issuing guarantees. 9. Commencing major litigation arising solely from events that occurred after the reporting period. And lastly, change in tax rate enacted or announced after the end of reporting period that has a significant effect on the current and deferred tax asset and liability. As to these examples, you will notice that there is no cash, income, or revenue involved or being stated because as to non-adjusting events, it is just concerned on a particular condition arises at the end of reporting period. Let's have financial statements authorized for issue. Stating that financial statements are authorized for issue when the Board of Directors review the financial statements and authorizes them issue. We had studied that financial statements was prepared to use and help in making economic decisions and to provide information to the users, which are the primary and other users. In some cases, an entity is required to submit the financial statements to the shareholders for approval after the financial statement have been issued. Since these financial statements are quantitative reports of the company concerning not only a couple of people but the whole company itself, so some entities are strictly checking their financial statement, making sure that there is no bias and misstatement. In such cases, the financial statements are authorized for issue on the date of issue by the Board of Directors and not on the date when shareholders approve the financial statements, which means that the day that the financial statement issued can be authorized on the same day when shareholders approve it. Example, financial statement issued on September 21, 2020 and expected to be authorized on September 23, 2020. But when the shareholders approve it on the same issue day, which is on September 21, 2020, on that day it could be authorized for issue.
And that's the end of chapter 12. Now let us proceed to chapter 13, which will be discussed to us by Mr. Mustapha and Ms. Palindac.
Hello everyone, good morning, good afternoon, or good evening. I am going to discuss the chapter 13 of Conceptual Framework and Accounting Standards, which tackles about related party disclosure. So without further ado, let's start. Technical knowledge. To understand the related parties, to know the requirement for disclosure of related party relationship, to know the requirement for disclosure of related party transactions. Related party. Related party. Parties are considered to be related if one party has. So we have three here. First, the ability to control the other party. Second, the ability to exercise significant influence over the other party. Third, joint control over the reporting entity. Control. So control is the power over the investee or the power to govern the financial and operating policies of an entity so as to obtain benefits. Or it could be ownership directly or indirectly through subsidiaries of more than half of the voting power of an entity. Significant influence. Significant influence is the power to participate in the financial and operating policy decision of an entity but not control of those policies. It can also be gained by share ownership of 20% or more. Joint control. Joint control is the contractually agreed sharing of control over an economic activity. The existence of significant influence is evidenced by the following. So we have 5 here where you can see the effect of significant influence. First, representation in the board of directors. Second, participation in policy making process. Third, material transactions between the investor and the investee. Fourth, interchange of managerial personnel. Fifth, provision of essential technical information. Examples of related party. Close family members of an individual are those family members who may be expected to influence or be influenced by that individual in their dealings with the entity. Close family members of an individual include: first, the individual's spouse and children. Second, children of the individual's spouse. Third, dependents of the individual or the individual's spouse. Individuals. Individuals owning directly or indirectly an interest in the voting power of the reporting entity that gives them significant influence over the entity. And close family members of such individuals. Post-employment benefit plan for the benefit of employees. Affiliates, the parent, the subsidiary, and fellow subsidiaries. Associates, the entities over which one party exercise significant influence. The term associate includes the subsidiary or subsidiaries of the associate. Venturer, venturer in a joint venture. A joint venture includes the subsidiary or subsidiaries of the joint venture. Key management personnel are those persons having authority and responsibility for planning, directing, and controlling the activities of the entity, directly or indirectly, including any executive director or non-executive director. Related party transactions. A related party transaction is a transfer of resources or obligations between related parties regardless of whether a price is charged. 9 examples of related party transaction. The first one is purchase and sale of goods. Second one is purchase and sale of property and other asset. Third is rendering or receiving services. Fourth is leases. Fifth is transfer of research and development. Sixth is license agreement. Seventh is finance arrangements including loans and equity contributions in cash or in kind. Eighth, guarantee and collateral. And lastly, settlement of liabilities on behalf of the entity or by the entity in behalf of another.
Related party disclosures. PAS 24 paragraph 12 requires disclosure of related party relationships where control exists irrespective of whether there have been transactions between the related parties. A related party transaction is a transfer of resources, services, or obligations between related parties regardless of whether a price is charged. In other words, relationships between parents and subsidiaries shall be disclosed regardless of whether there have been transactions between those related parties. This means regardless of whether there have been transactions between a parent and a subsidiary, an entity must disclose the name of its parent and, if different, the ultimate controlling party. If neither the entity's parent nor the ultimate controlling party produces financial statements available for public use, the name of the next most senior parent that does must also be disclosed. Disclosures of related party transaction. PAS 24 paragraph 17 provides that if there have been transactions between related parties, an entity shall disclose the nature of the related party relationships as well as information about the transactions and outstanding balances necessary for an understanding of the financial statements. The objective of this is to ensure that an entity's financial statements contain the disclosures necessary to draw attention to the possibility that its financial position and profit or loss may have been affected by the existence of related parties and by transactions and outstanding balances with such parties. As a minimum, the disclosures of related party transactions shall include letter A, the amount of the transaction, B, the amount of outstanding balance, term and conditions, whether secured or unsecured, and nature of consideration to be provided in settlement. C, the allowance for doubtful accounts related to the outstanding balance. Lastly, the doubtful accounts expense recognized during the period in respect of human due from related parties. Key management personnel compensation. PAS 24 paragraph 16 provides that an entity shall disclose key management personnel compensation in total and for each of the following categories: short-term employee benefits, post-employment benefits, for example, retirement pensions, other long-term benefits, termination benefits, share-based payment transactions, for example, share options. When key management personnel are paid a single salary in respect of services to more than one entity within the group, the amounts paid should be allocated between the services provided to different group entities for the purposes of the separate or individual financial statements of each group entity. Related party disclosures not required. PAS 24 paragraph 3 requires disclosure of related party transactions and outstanding balances in the separate financial statements of a parent, subsidiary, associate, or venturer. However, paragraph 4 provides that intra-group related party transactions and outstanding balances are eliminated in the preparation of consolidated financial statements of the group. Related party disclosure requires disclosures about transactions and outstanding balances with an entity's related parties. The standards define various classes of entities and people as related parties and sets out the disclosures required in respect of those parties, including the compensation of key management personnel. Unrelated parties. Unrelated parties include the following: two entities simply because they have a director or key management personnel in common. Providers of finance, trade unions, public utilities, and government agencies in the course of their normal dealings with an entity by virtue only of those dealings. A single customer, supplier, franchisor, or general agent with whom an entity transacts a significant volume of business merely by virtue of resulting economic dependence. Two venturers simply because they share joint control over a joint venture.
And that's a wrap on our report. This has been Group 6, your reporters for Chapter 12 and Chapter 13. Thank you for watching!